Hey there, and welcome to today's Explainer. We're diving right into a massive financial transition that pretty much everyone faces at some point. And honestly, it's a topic I absolutely love talking about, moving from simply stashing your cash in a savings account to actively building lasting wealth. I remember exactly how confusing and overwhelming this all felt when I first started out. So today, I'm just gonna walk you through this like an older sibling would, because here's the reality. Most people think they're doing the absolute right thing financially when they start saving their money. And you know what? They are. But saving is really just the starting line. Today, we're breaking down a super simple step-by-step path from our source material that shows how ordinary people can turn those savings into long-term wealth safely, smartly, and without taking on crazy risks. Let's get into it. I want you to picture my friend Alex. His situation is just incredibly common. Every single month, Alex does the responsible thing. He puts a little cash into the bank. Sometimes it's $100, sometimes $200, and slowly that balance grows. It feels responsible, right? It feels safe. But then something kind of frustrating happens. One day, Alex opens his banking app, looks at his balance, and sees he has thousands sitting there. Yet, after an entire year, the interest he's earned is barely enough to buy a cup of coffee. His money hasn't really grown at all. Meanwhile, everywhere he looks, people are talking about investing and index funds and compounding. And suddenly, he's asking himself, am I missing something? Well, I am absolutely here to validate those good savings habits, but I also have to tell you, yeah, you kind of are. You see, saving and investing are simply not the same thing. Think of it like a garden. Saving your money is essentially building a really strong, sturdy fence to protect your seeds from getting eaten. Now, that fence is absolutely crucial. It's safe and it keeps your seeds secure. But a fence alone won't actually grow anything. Investing, on the other hand, is taking those seeds and planting them in fertile soil where they can multiply. You literally need both, the fence and the soil, but they serve completely different purposes. Saving protects your money. Investing grows your money. The biggest wealth gap out there isn't actually between spenders and savers. The real gap is between people who only save and people who invest. To put that into perspective, just imagine leaving $10,000 sitting in a traditional savings account, earning one of those tiny, microscopic interest rates. After years, the growth is painfully slow. You're barely moving the needle. But contrast that with putting those seeds into the soil. Historically, long-term investments in the stock market have grown much, much faster over time. And why is that? Because of one of the most powerful forces in finance, compound growth. Compounding literally changes the game. In the early days, the difference between the saved money and the invested money might not look like much. But as you stretch this timeline out over decades, the gap becomes massive. Compound growth is, without a doubt, the ultimate wealth builder. Now, I know what you're probably thinking. This is where the psychology becomes just as important as the math. Saving feels safe because your money doesn't move. You log in and boom, it's sitting there peacefully. Investing feels totally different. Markets go up, markets go down, prices fluctuate all the time. And emotionally, that can be totally nerve-wracking. A lot of absolute beginners avoid investing altogether, not because they aren't smart enough, but simply because that uncertainty makes them deeply uncomfortable. Listen to me, that fear is completely normal. It is totally okay to feel uneasy when you see those numbers bounce around. And that is exactly why smart investing should never ever happen all at once. We do it in stages. Knowing where to actually start is half the battle. And that brings us to step one, the emergency fund. Before you invest a single dollar into the market, you've got to have cash saved up to handle life's unexpected problems. We're talking medical bills, a sudden job loss, major car repairs, the stuff life throws at you. Why is this so critical? Because the absolute biggest reason people panic and sell their investments at the worst possible time is really simple. They needed the cash immediately. An emergency fund is your shield. It prevents you from being forced into a bad, panic-driven decision just because you suddenly needed liquid cash. Once you have that shield in place, you need to make a massive mental shift. You need to separate your money into two totally distinct buckets: safety money and growth money. Your safety money is your emergency fund. It stays stable. Its only job is to protect you. Your growth money, though, is designed to increase over time through investments. Just making this simple mindset shift reduces your financial stress so much. Why? Because you finally stop expecting your investment money to behave perfectly peacefully like your savings account. You expect the growth money to jump around a bit, and you expect the safety money to just sit there keeping you secure. Okay, let's bust a major myth that stops so many people before they even start. A lot of folks think you need huge, massive amounts of cash to start investing. You don't. You could start with almost nothing. What matters most in the very beginning isn't making massive profits. It's simply building the habit of consistency. Consistency beats intensity in investing almost every single time. It's not about dropping 10 grand in one day. It's about putting in a little bit, week after week, month after month. Starting small and just being stubbornly consistent is what actually works in the real world. And focusing on that consistency naturally protects you from the biggest trap beginners fall into: complicated strategies. When people think they need to make money fast, they start chasing excitement. They get totally sucked into day trading, they mess around with options, they buy into whatever the latest crypto hype is. Basically, they're trying to get rich overnight. But ironically, as our source text points out, the investments that perform the absolute best over the long haul are usually the simplest ones. When you chase excitement over real results, you're just taking on unnecessary risk. So what's the solution to those risky strategies? It's the index fund. Instead of trying to guess which single company is going to be the next big thing, which, let's be honest, is basically just gambling, index funds let you invest in hundreds of companies all at the same time. Imagine it like buying a single basket that holds a tiny little piece of hundreds of different successful businesses. What does that do for you? It gives you instant diversification. It drastically lowers your risk. And it means you get the long-term growth of the entire market working in your favor rather than crossing your fingers and relying on one single stock. And hey, you don't just have to take my word for it. Legendary investors, including the one and only Warren Buffett, have repeatedly recommended simple, low-cost index funds for the average investor. That is a massive endorsement. It proves that you don't need a fancy Wall Street degree or some highly complex, secretive strategy to build wealth. The most effective long-term investments are very often the most straightforward ones. If simple index funds are recommended by one of the greatest investors in human history, well, that's definitely a strategy worth paying attention to. Which leads us to a totally underrated truth, and honestly, it's one of my favorite points in this whole explainer. Successful investing is actually boring, and we really need to rebrand the word boring as a wildly positive thing. True wealth building is not about excitement. It's not about the adrenaline rush of executing a day trade. It is entirely about discipline. It's the incredibly disciplined approach of consistently investing a fixed amount of money every single month for years. It's routine, it's predictable, and that boredom is exactly what allows your money to quietly go to work for you in the background while you go out and live your actual life. When you visualize this discipline over time, you can really see the true power of compounding at work. In your first decade, the growth just begins. It honestly might not look like much. But as you hold those investments into decade 2, that compounding starts to accelerate. By decade 3, something literally magical happens. Your money has generated growth, and now that growth starts generating even more growth. It's exactly like a snowball rolling down a huge hill. And by decade 4, your wealth building truly peaks. This illustrates perfectly why experienced investors don't think in days or weeks. They think in decades. But of course, even if you are thinking in decades, investing can still feel emotionally uncomfortable sometimes. Markets will inevitably crash. The news headlines will become incredibly scary and dramatic. People around you are going to panic. So what's the best tip for managing those emotions? Turn off the financial news apps. Seriously. Long-term investors understand that market downturns are completely normal. In fact, when prices fall, consistent investors are actually just buying assets at a discount. They are getting cheaper prices, which can increase their long-term returns when the markets eventually bounce back. You don't panic when your favorite grocery store has a sale, right? Well, consistent investors don't panic at a downturn in the market. All right, let's bring this all together. Here is your absolute beginner's roadmap to transition safely from saving to building wealth. Step 1, build a real emergency fund to protect yourself. Step 2, mentally separate your stable safety money from your fluctuating growth money. Step 3, start investing small amounts consistently. Step 4, focus on simple, long-term investments like index funds. And step 5, stay patient long enough for compound growth to actually work. To kickstart this, here are 3 specific habits to build starting today. Number 1, automate your monthly transfers so you literally don't even have to think about it. Number 2, completely ignore your portfolio balance for the first year. Just don't look at it. And number 3, treat your investment contributions like a non-negotiable utility bill. At the end of the day, saving your money gives you security, but investing, that gives you opportunity. The earlier you learn how to confidently combine both of these tools, the more powerful your financial future is going to become. We've looked at the data, the mindset shift, and the step-by-step path outlined in our source material today. So I want to leave you with a final thought and a simple monthly checklist to keep yourself on track. Did you pay yourself first? Did you ignore the hype? Did you stay consistent? How will you combine the absolute security of saving with the incredible opportunity of investing to empower your own financial future? Take that roadmap, stick to those habits, and go see what you can build. Thanks so much for joining me on this explainer.